I believe that 2020 is going to be a little bit more challenging for investors. The global economy continues to weaken. Valuation, especially in US equities, is a little bit unattractive. Earnings are falling. So we expect equities to have single-digit returns for 2020. For equity investors, we believe that the best choice is to move away a little bit from the US stocks into emerging market stocks and European stocks. The valuation of European and emerging market stocks is more attractive. There is more upside to growth in Europe and in emerging markets. And we feel that the weakness of the dollar we expect to happen is going to be positive for emerging market stocks especially. With bond yields falling to record lows this year, we expect next year to be much more difficult for bond investors. We expect positive returns only in some emerging market bonds and potentially in US Treasuries because the US economy will continue to be weaker than expected. The outlook for European government bonds and also for developed market credit is much more challenging. On one side, European bonds are still trading at negative yields, and when we look at credit, credit spreads are still very, very low, earnings are falling, and corporate leverage is very high. We believe that 2020 will mark the end of the bull run in the dollar. The dollar is significantly overvalued, the US economy is weakening, and the Fed is cutting rates. This is not a good starting point for the dollar. In conclusion, we believe that 2020 is going to be a much more challenging year than 2019. We would expect European stocks, value stocks globally, and emerging market debt to offer the most attractive returns.